Welcome back to the first meeting of the Income-Based Education Tax Study Committee. We just finished our break. We are going to hear from Jake Feldman at the Department of Taxes, who is going to take us through some findings from a report that we were talking about earlier in our meeting today. The tax department was tasked with sort of administrative challenges related to moving to an income-based education tax. And so we've sort of put off our meeting until later in the fall so that we could make sure we are making the most of all of the work that Jake and his colleagues have been doing this year. And so thank you, Jake, so much for coming.
Thank you for having us. I'm Jake Feldman. I'm a senior fiscal analyst at the tax department. And we do really appreciate being invited in this early. We look forward to helping you with the technical parts of your report. As Representative Kornheiser mentioned, we have our own report due January 1st. It has 4 of the same things as yours. It has like, how do you transition the renter credit? What are the differences between AGI and household income? And then the 2 other ones are administrative issues and transition issues. And part of my voice, I caught a cold from my kindergartner. And so, but I'm on the upswing. And my presentation is mostly covering those things that are going to be in our report. There's a few other concerns that we would like to flag now very early in the process. It's a little bit dense. So I put in animations so that each slide was kind of more manageable. So
Jake's going to screen share. You probably don't want to look at your own device because it'll be the PDF instead of the sort of staged animations.
Okay. So I'm going to press this magic button and see if it works.
We did a test run during the break.
It says you are screen sharing.
But you're not.
Oh.
Dan sees it.
Zoom, but it.
That's not here.
Because the section is that.
I'm seeing it.
Oh, that's good, Ann.
His camera's off, maybe.
We did a test run and it came up on the screen, so I'm not sure.
We could just do regular,
Fortunate.
not screen sharing.
Okay. Will you send us all the PowerPoints, Saoirse?
Yes.
It's on.
It's on the website, JFO.
Well, I have the.
No, I mean the actual PowerPoint.
that has animations, I guess. I'm gonna send it to you guys.
We need the animation, what, I mean,
Well, then you'll get the animations that Jake put in so as to have slides that are, I don't think they're like dancing people. I think it's
Yeah.
just, it stages the information.
Right.
Yes.
I think we can
Just want to
handle
be
that.
clear.
I promise not to look at the other
Okay,
bullet point before I
Okay,
read
great.
the other.
Okay.
I'm going to try that button one more time and then I'm going to give up.
Share content.
Here.
Hold on. Unmute participant sharing.
Oh, here we go. It's gonna work.
Don't need a video of me.
We actually probably should have a video of you.
Well, he is on our,
Oh, on the YouTube.
I am seeing the entry page.
Okay.
how nice for you.
Okay, whatever.
I
It's,
know.
we're going to work our way through this.
For me,
It's
it's helpful.
great.
Okay, well,
Okay.
um,
Jump in however works for you, Jake.
So she can follow along this way.
okay.
And the Zoomers can see it.
Okay, let's give this a try. So luckily there's some huge red numbers on the top of each slide.
Yeah.
That are the slide that we're on. Our study is in Act 127. Yours is in Act 175, I believe. And now. So one of the first things is the difference between household income and AGI. And that's in your charge and in our charge. Since Act 60 passed, household income has been basically fine-tuned by the legislature. There's been very frequent changes, and JFO has a full accounting of them. Some of the main ones are that in 2000, basically business losses or capital losses were for the most part cut off. So in AGI, you can take a big business loss in a year, but in household income, you can't. In 2004, the definition excluded the income earned by a dependent up to $6,500. So if your kid is living with you and has a job, you get to exclude $6,500. In 2007, they brought in gifts in excess of $6,500. So that's very much outside of AGI. The federal government has a separate gift tax on gifts over $15,000. Wow, $15,000. Great.
Hey, all right.
You better beat that.
Super.
And then in 2010, double counting interest and dividends over $10,000. This is trying to sort of correct for people who have a lot of passive income coming to them, sort of independently wealthy, potentially people. And at the same time, all of the subtractions from AGI that Abby just mentioned were disallowed. And then in 2012, the legislature adjusted that to only double count the interest and dividends of people under 65. So it doesn't do that for seniors.
The seniors mobilized 2 years.
Yeah, and then I think Julia or Abby maybe mentioned it.
Sorry,
Sorry, go ahead.
question already.
Yeah, I don't really understand double counting interest. How does that work?
If you earned $15,000 of interest and dividends, 15,000 minus 10,000 is 5,000. So it would actually count as 20,000 of interest and dividends if you're under 65. So it's kind of like inflating it a little bit.
Because you get a $10,000 because of the standard deduction, you mean?
No, it's not related to standard deduction. It's like if you have any interest in dividends beyond 10,000, that's the part that gets double counted. If you just had 9,000, there would be no double counting. But if you had 11,000 and you're under 65, it would count as 12,000 for household income.
So fancy.
So there's much more than this, and the place to look is definitely JFO's fiscal facts. That's where I got this stuff from. And the most recent change was last year, excluding the income of a refugee or asylum seeker from household income. So this ends up in a much different income metric. And before I go through these things, I should say that the biggest difference between household income and AGI is that household income is the income of everybody in the house for as long as they're in the house. So your cousin moves in with you for the year, they're going to count in your household income. AGI is a different thing. That's based on a filer. So my wife and I were filing separately for many years. And under AGI, we would have two different AGIs. So that in itself creates winners and losers. So if you imagine like somebody who is in medical school and maybe makes a small amount of money, and their spouse is a doctor and makes a large amount of money. Let's say the medical school person makes 10,000 and the doctor, let's say, makes 200,000. Their household income is 200 plus 10 is 210,000. But if you're looking at just their AGI, then the person who earns 10,000, the medical student, would have an education tax that's sort of in that the circuit breaker zone. So they're very different constructs. Household income is kind of like everything under the sun, total ability to pay for everybody. Whereas AGI is what the federal government has decided should be included in AGI. And it does change from year to year. There are a lot of differences, and Abby did a great job with enumerating all of them. I'm going to talk about some of the main ones and how much money there shows up for those line items. In the eventual report, we're going to show you not only how much money there is, but how many resident taxpayers are reporting this kind of income. For now, one of the big ones is non-taxable Social Security. That is included in household income, and that's why there's that checkbox, but it's not in AGI. AGI is only taxable stuff. And that's 1.2 billion in 2019.
So all the sum of all of the non-taxable Social Security that Vermonters are receiving in 2019, is that what you just said, was 1.2 billion?
2019, yeah.
Okay, thank you.
Yeah. All Vermont resident income tax filers.
Non-taxable portion.
Yeah. So actually, when you receive Social Security, you get a monthly check of around $2,000 or whatever. But it's not until you go to do your taxes where it's separated out how much is non-taxable versus taxable. And it kind of depends on some factors.
I have a really nice chart about that if anyone wants it at any point.
Is it animated?
Graham made it for me last year. It's not animated.
Non-taxable interest is one way to avoid taxes is to invest in muni bonds. Those are not taxed by the federal government. And there's 0.1 billion or 100 million of that in 2019. Non-taxable capital gains is a really unusual one. That's like when you go to sell your primary residence, your home, for the most part, that gain is not taxable. I don't want to overburden you guys with technical stuff. So I'll just say for the most part, it's not taxable. In household income, that's actually included. In AGI, it's not. So that's one of the very, very unusual features of household income. The double counting of interest and dividends we talked about. Roth IRA earnings are in household income, but not in AGI. Cash gifts we mentioned. Household income does have an unusual thing where your payroll taxes, which are like the Social Security and Medicare that gets withheld, you do get to subtract that. And self-employed people get to subtract half of it. AGI lets people who own businesses or farms subtract their losses. Household income doesn't for the most part, except in a very rare case. And then AGI also has all these other deductions that Abby had in her report for teachers and self-employed people, IRAs, loans, on and on.
Yes.
Did you not have the amounts for some of those just because they're so small, like the gifts of over $6,500?
Yeah, they're pretty small. Either that or I'm still working on quantifying them. Yeah. Also, since Act 60, the credit or it was called an adjustment, now it's called a credit, but it's been reduced and property has been taxed more over that period. Right after Act 60, people were getting some very big checks. The anecdote I heard when I started at the tax department is that like people in Charlotte and Shelburne were getting $35,000 checks or something. Since then, there have been limits set by the legislature. In 2007, the maximum adjustment that you could get was lowered to $10,000. And then a year later is lowered to $8,000. In 2010, the maximum house site value that's eligible was lowered to 500,000. And then I was there in 2018 when that house site limit was lowered to 400,000 and the credit was split and the maximum education was 5,600. Representative Beck, you look puzzled.
I was on that conference and we did the 400, but the 5,600, was that done in the same?
Yeah, same bill. So so that was what the thinking there was pretty brilliant, in my opinion. It's basically like, and I'm diverging a little bit here from the report, but giving some props to Ways and Means. Because when you get a tax bill, it's got an education part and a muni part, right? And before, it used to be you get this credit and you couldn't parse out, what is this credit? Was it education or muni? It was just some big number. But then Ways and Means did the math on how do you keep people like whole, basically like what they're getting, but separate the two credits so people can see what's being applied, which I think was great for transparency. And at that time, that's when the maximum education credit was set at 5,600.
And there's no inflation adjusters in that maximum.
There is not.
Okay.
So you guys are well-versed on this stuff, especially after Julia's presentation, but there are other members of the legislature and members of the public who are not as well-versed. And here are some common misconceptions. The first one is that all lower income households pay based on income. That's false. People only get a credit, meaning they pay on income, if it benefits them to pay based on their income rather than their property value. So there's a good sized population where it doesn't benefit them, they're not paying based on income, they're paying based on property because it's lower.
You're going to tell us how many people that is at some point soon.
I was just like thinking about that when I was walking to work. How many is that? If someone was going to ask me. I can tell from the data, but it's going to have to be homework from me.
Okay.
I don't know it off.
I looked at that a couple of years ago. I think it's like 8 to 10,000 households.
Okay. Well, let's wait and have Jake tell
Is
us.
what's your question? How many pay?
How many folks are paying just on their lower income folks who are paying on their property other than their income?
Their income liability is greater than their property liability, so they just pay the property liability.
Second, any shift towards income helps lower income households. That's a popular misconception. For the low and even moderate income households that currently pay based on property, it forces them onto a higher track.
I mean, that depends on what the rate is, doesn't it?
Right, yeah.
That's taking the credit.
Yeah, so
So if, say, the income, if we did this and we set the income tax percentage rates at, a progressive rate, then that might not be true necessarily.
right, and that's actually really helpful. So in our study charge, it says, N income-based
Yes.
education tax, and we have to know, what are you talking about? There's a lot of things you could do. You can do a progressive structure. You could tack on to what we have now for regular PAT, but what we're going off of, and this is kind of key to some subsequent slides, is there was a proposal in the Senate S212 last year, and very similar or the same language in the House. I don't know the bill number, but those were basically what the Tax Structure Commission recommended. And that's the guiding in all of this, because we have to know, what are they talking about?
Mm-hmm.
Jake, sounds like dig us more precise numbers, but can you give us a sense, is it 5% of people that would be eligible don't do it, or 25%? Do you just a crude ballpark? You said it's 8 to 10,000 households.
That's what I remember being.
So that's,
I'm guessing that Representative Beck is probably ballpark correct, but I need to go do my homework on that.
And we're going to dive deep into the numbers and the curves in a couple of meetings.
Okay. Okay. Third misconception, in the current system, you either pay based on income or property. That is not true. The current system has limits on how much property value is income sensitized. And beyond those limits, you pay based on property. So if you're under $90,000 in household income, you're covered only up to $400,000 of house site value. And that was reduced 3-4 years ago from $500,000. And then if you're over $90,000 in income, it covers you up to $225,000 of equalized house site property, equalized house site value. Okay, so who would pay more? The education income tax, and again, I'm looking at S212 here. It increases taxes on homeowners whose property value is low relative to their income. This includes a broad swath of working families living in modest homes. For example, mother and daughter who work at UVM MC in environmental services and live in a $50,000 mobile home. They each make the UVM's new minimum wage of $20 an hour. They pay about $750 now in education taxes, but they would pay about $2,000 under the proposal.
And
Yeah.
further questions, how many homes? I mean, I don't think most of the mobile homes in my district are valued at 50,000. I think most of them are valued higher than that. So that's another sort of question for the future.
Yeah, so it's possible to like really quantify just mobile homes if you ever wanted to. I could do that, or I could help JFO with that. It's not that hard. But I think I have some subsequent slides that are going to give you a sense of.
We should let you go for a little faster. I'm sorry.
The questions are great. I was hoping for questions. Who would pay less? It decreases taxes on homeowners whose property value is high relative to their income. So suppose you were really slick and you had your trust fund invested in muni bonds and you were getting all tax exempt interest off of it. And you were living on $40,000 a year in $1 million home. You pay about $11,000 now and you would pay nothing under the proposal. This trust funder situation, is probably rare. Honestly, to be totally honest, the people whose income is very low relative to their property value is more likely to be seniors. They're living off Social Security and they're living in a very large family home, like in my neighborhood. If you guys ever want to do a field trip for this, come over and speak. They're wonderful people. I love it. But that is the situation in my neighborhood. It's all these large houses with very few children. But that's who would pay less.
There's a pretty good chance they've been living there a long time.
That's so potentially. And what we hear in the legislature is that these are grandmas on the farm. I don't know if people still say that.
God, I hope not.
I haven't looked at it in a while, but you would be surprised by the number of people who are getting these huge tax credits who actually bought their house very recently. So that the data does not support that these are all people who have been living there a very long time. And if that's a thing you want to look into, I'm happy to run it again. Okay, so I have these tables coming up, and I'm so glad that Saoirse was able to work her magic, because it's just too dense to just plop the table on you without any kind of background. So I'm about to show you the average change in FY20 education tax under current law versus the education income tax. And there's going to be a lot of cells with colors. But I was hoping that if I showed you just one cell, it might help you understand them all. So I broke up the house site values into these different buckets, 0 to 100,000, 100 to 225, 225 to 400 and over 400. And you guys all know why I chose 225 and 400. Because in current law, which is a hybrid system, there are cutoffs at those points. Similarly for income, there's a cutoff at $47,000. That's the circuit breaker. And then there's another one at 90,000. And then 140,000 is like the end of the program. And then I put these other ones in for reference. So we think that it's very helpful to look at it this way because the current system is a hybrid property and income system. If you guys were considering a change to our personal income tax, I would probably show you income bands and like change to effective tax rate because that would be the relevant thing. Mm-hmm. But we're not coming off of that. We're coming off of a hybrid property and income with clear cutoffs. So this top cell that I'm using as an example, that's looking at the households who have a house site value between 0 and 100,000. Their income is between 0 and $47,000. That 11,530 number, that's how many of them there were in FY20. And that $30 number, and it's got brackets around it because it's like accounting. That means a negative. It means a $30 decrease on average. And the reason that cell is green is because households in that sort of grouping or bucket are likely to see their taxes go down with an education income tax. Okay. It's not definite. Like I have kind of wide bands and
it's average.
Yeah, and the rates vary across Vermont, but it's likely that that group would see a decrease.
Can you remind me how many households are in Vermont? How many how many homesteads?
About 170,000. Okay, so.
Senator Perchlik, did you have I think I cut you off.
No,
$30.
30, the average is $30 though,
Okay.
with all the caveats. The well would go down.
Okay.
So this is the average change under, again, I'm modeling S212 here, and the count of how many, resident households who are homesteads, basically, in each bucket. And so it's a lot of numbers and it's here for your reference for when you need it, but you can kind of get a sense of, some of the quantities you were just thinking about, like how many people fall into these. And you can also really see because of that diagonal, how if your property value is high relative to your income, would likely, benefit you. And if your property value is low relative to your income, you would likely not benefit.
Sort of a bigger methodology question, but I remember when JFO was trying to model this for us last year, there was a big problem for them with matching household income to AGI when you got up. How did you solve that problem?
So the data all comes from the tax department.
Yes. And
I solved it by doing a lot of work that I should have probably tried to do earlier. But it's hard to build a data set. And now tax and JFO are in the possession of the exact same data.
So what?
Pardon?
What data?
The exact same.
Exact same. Thank you. I just didn't hear you.
Which is good.
That's great. Thank you.
I guess a couple other things about FY20. So we share the data set, which is good. That's to 2019 income, so before the pandemic, which is kind of like more ordinary looking. from 2020, we've seen some weird stuff. 2020 on, and also property value has done some weird stuff. So we're going to update the data set probably later this fall. But for now, we're just running with FY20.
Thank you.
And JFO has already presented FY20 analysis, but arranged.
Chris?
You have, it seems like I'm trying to do some math on the fly here, but the green, there's a lot more people or house sites in the green than in the red. Do you have that later on?
It was pretty even. I tried, this slide was so busy that I didn't add like row and column totals. But I think it was fairly even in terms of winners and losers.
And I'm looking at the 7 biggest buckets up there and six of them are in the green and one of them's in the red.
Yeah, that's sort of how
Yeah, it's like 27, 30.
But I don't know. There's also more red squares than there are green squares, maybe, I think.
but the bottom row
Yeah,
is pretty
okay.
tiny.
All right.
Anyway, all right.
The little asterisks are because there's fewer than 10 filers, and so I can't disclose that.
Yeah.
Are filers that have over $1 million income and live in a house under 100,000?
Sorry?
There are filers that have over $1 million in income and live in a house valued less than 100,000.
Yeah, there are. And that's a really good lead-in. So in Vermont, the population of people who have $1 million or more in income year after year after year is low. It's a few dozen, and if I listed the names for you, you would recognize the vast majority of them. And usually in Vermont, when you have over $1 million of income, it's because you're selling a major asset, such as your business. Or if you own a mutual fund, if you liquidate it, then you could have that kind of income. It's usually a one-time event. That's how tax and JFO usually describe it. I have a couple of sweet animations here. Cool. So that first example of the mother and daughter who work at UVM MC, they would fall into this grouping. Their tax change was $1,250. The average for their cohort is a $500 increase. The second sort of trust fundy example would fall into that grouping, and that person, their tax change was like 11,000 or something, but the average for that group is 5250. So if you can get that one.
Yes.
I'm sorry. So is that 5250 average, is that based on their tax bill or their property tax liability?
It's
Because these people are they get the sweetest deal, right? If you're under 47 in terms of income sensitivity.
right. I think my ears might be a little stuffed too, so if you could speak up, I couldn't hear the second part.
So if you earn under $47,000, you are in the best position for income sensitivity, as I remember. And so is the savings based on their tax bill, what they're paying, or what their property tax, pre-adjustment is? That's what I'm wondering.
The saving is for current law, it's their net tax bill. It's their property tax minus their credit. That's what they get under current law. And under the education income tax, it's the rate in S212 times their AGI.
Okay.
I just want to remind, so it was absolutely a reasonable and appropriate choice to work with S212 for writing your report. Absolutely, of course. You have to work with something. We didn't give very clear instructions, as we sometimes do, or don't. This is not the S212 implementation committee, though. So I want to make sure that we all, as we're having these conversations, recognize some of the challenges that might be inherent in 212 and are sort of thinking through more broadly about ways to approach them.
And I don't know if anyone can see me. Can you?
Sorsha is watching you and then telling me if she sees you, but feel free to just jump in, and it might be tidier.
I guess I did hear Jake say that they are updating this table or the calculations based on the recent rapid increase in many sections of Vermont in property values. A $400,000 house in Montpelier right now is a modest ranch, hardly a high-end house. And I know other areas, I know all of Chittenden County is doing that. So it'll be interesting to see what recent inflation has done. And maybe it'll come down before we do that, but be interesting to see how that plays out.
Agreed.
And I know that I'm doing a lot of math in my head to turn this into percentages, and I see Senator Pearson with a calculator. So I think at some point, seeing percentages on this would be cool, either from you or from JFO, whichever, but.
We did those. We did a lot of stuff, but, just like.
Yeah, this is great. Yeah, no.
Betting green and, it's not Christmas yet, so.
Yeah.
I did just try to calculate the counts, and in the green box is 126,000 house sites, and in the red is 43,700. So it is, whatever that is ratio, unless I'm, just trying to do quick math. Maybe I made a mistake, but
5, 6, 22, 4 is 26, 10 is 36.
I think your math is good.
yeah. So I mean, it's important because it doesn't offer the scale, but.
Yeah, agreed.
You're about 2/3 are in the green, 1/3 are in the red.
That could be the case.
Okay. But we'll look deeper at these.
So this is just the total of money. So you take the average and multiply it by the count and you get the total, and this is in millions. So this one is helpful because you can see that the $1 million household income group would pay about $30 million more, which is consistent with, I think, what JFO showed during the session. It's helpful here also to see that households who are in over 400,000 house site and have income up to 250 would have taxes go down by about 35 or 36 million.
Okay.
And I think that in your charge, there's like, should there be a limit on the income? And so I don't know, you can, if you truncated it at $1 million, that doesn't mean you lose this $30 million on the bottom line. It would just be less than what it is now.
And Jake, is it fair to say that 22.63, that far bottom right block, I mean, is that those people that are in that bucket, that's a one-time event? Those people are all mostly one-time events?
Probably mostly, yeah.
Okay, all right.
People with one-time events are still people with money in that year. It's still real income in that real year. And it seems to be a similar number of people each year, which I think is sort of.
That is awesome.
But we will talk so much more about that soon, and I want to make sure we stay in presentation.
Yeah, thanks. A question from my tax colleagues was, how is the median household affected? The median household income in 2019 was about $73,000. And the answer is it kind of depends on what house they're in. If they're in that ramshackle looking house that I found on Google, which may or may not be in Vermont.
Hey, that's mine.
It's not that ramshackle. It's like a really well mowed lawn right there.
The lawn and landscaping. So I thought it was worth about $50,000. So they would pay about $100 more. The median, a neat mathematical thing, the median for 2019 for house site value was about 200,000. And then I went to go look around 73,000 of income within plus or minus $1,000. And the median for that was also the same. So that was good.
Well, there you go.
In a median house, they would pay about the same. And then if they are lucky enough to own that greenhouse with very nice landscaping, including some natural boulders. That is not my house. I valued that one at $500,000. They would pay $1,400 less.
And does this assume the same amount of household income in each?
Yes.
Yes,
Okay.
$3,000.
That's great.
Okay, all right.
And, there's a little note about that $200,000 house. And Rebecca asked me yesterday, like, well, how does somebody with $73,000 of income end up in a $500,000 house anyway? There's a lot of answers. You can be there with your spouse and raise your kids, and then your spouse retires. That's one way to end up there. You could sell your place in Massachusetts and make $1 million and then buy that place. That's what happened down the street from me. Or maybe you have something else that I'm not thinking of, but there's a lot of ways that you can end up there.
House could just appreciate.
Right.
Could appreciate
And your income did.
Maybe you're an expert builder and you built it, I don't know. So let's talk about renters, which is in your charge and our charge. I have to say on renter credit, I am, that it's like has a dear place in my heart because I, helped design most of it. So I'm a little protective of it, but the new renter credit. But anyway, so how would renters be impacted? As you know, and we know, they would be exposed to two education taxes. The income tax that everyone is paying and that non-homestead education property tax that they pay indirectly through their rent. It's very difficult to know exactly how much they would pay in income tax, but we use census data and we think it's about $70 million.
If it was at 2%, that's based on the assumption out of whatever it was.
Yeah, so S212 has kind of like a new circuit breaker. It's very algebraic, but if you're married and under 50,000, then you have kind of a ramp up to the income rate for your town. And if you're single or any other filing status, it goes up to 25,000. It ramps up. So it's difficult back of the envelope stuff, but it seems ballpark that they would pay about 70,000. So in the Tax Structure Commission's final report, they recommended changing the renter credit program to try to give renters back the entirety of the non-homestead education property tax that they pay through their rent. And I think in the report, it recommended valuing rental units individually to try to do that, which would be a change from current practice. There are other ways to do it. Like when we did renter credit, we use these HUD values that I think Abby mentioned. So either way, we look at it a couple ways and we think it would cost about $110 million per year to try to give them back the non-homestead property tax.
To make everybody whole that's renting.
Yeah. And importantly, for their finances, on a bi-weekly basis from their paychecks, they would be paying this income tax. So it reduces their take-home pay, or monthly, probably bi-weekly, but anyway, it reduces their take-home pay. And then in March or April, when they file for the new renter credit, they would get a massive check. So it's quite a change in terms of cash flow from that person's perspective. The current renter credit costs about $10 million from the general fund.
I've not been clear in my mind how the contribution would come in. So you've made an assumption that it would go through the withholding like normal wages, but which, I mean, that's on my list of things we have to figure out.
Right. And again, like we have to, we need something to know what to talk about the administrative challenges from. So we were looking at S212. Did I have something else that I wanted to say here?
You have an asterisk. Does it mean something?
I do? Oh, it's just a little
Comment.
note about how we got that number. Very back of the envelope kind of calculation. Right now, the renter credits paid out of the general fund, it's like up to 10 million bucks a year. But, you know, you're talking about, you need $100 million more in this scenario. So, you know, I don't know, there's various ways, I guess, to come up with that, but it's it's a change in the program cost of 11, scale of 11 times as much.
Can someone remind me why the decision was made for the renter credit to come out of the general fund rather than the ed fund? It seems like a very ways and means move, but I just don't.
It always
That happened.
was.
Yeah, I think it was just looked at more as a rental subsidy than.
Okay. Like a human services expense
Yeah,
of
exactly.
sorts?
Right,
Okay.
exactly. Yeah.
And I think rather than a decision, it was the renter rebate was always out of the general fund. Maybe somebody can verify that. So it just wasn't changed.
I'd be happy to look into that. I would just add that there used to be the general fund transfer. So
Right,
I
right.
don't know. I wasn't here.
That was also in that
But
2018.
I think it was the same time that was.
Thanks.
I think renter rebate was split, 70% out of one fund, 30% out of the other fund. But I can't remember which fund was 70 and which was 30.
So we got rid of that when we got rid of the transfer.
When we got rid of the transfer in that 2018, yeah.
Okay, thanks.
So from a tax department perspective, we just transitioned the renter rebate to the renter credit. And the goal of it was to make it easier to access for renters and potentially easier for us to administer in the long run. We followed the recommendations of previous groups that had studies on it. So it's just been changed. And it does take work for the tax department to overhaul these things.
Jake, question. In that difference between 110 million and 10 million, second bullet, how many people does that equate to? How many additional thousands of people would apply for the credit? Have you guys run that number?
Yeah, that's an excellent question. Wouldn't every renting household be
Yeah.
eligible?
Right, I mean, it's a lot more people
Right.
that are filing for that, yeah, okay.
Or would you allow some renters to be double taxed and not others? Like what I guess what I'm saying is like, the goal would be to avoid double taxation. But would you say like, if you rent and your income is up to 100,000, we're going to prevent the double taxation, but if your income's over 100,000, we're going to let it go.
Well, we kind of do that right now. Not everybody qualifies for rent rebate.
That's
Right.
interesting.
Yeah. So right now,
Doubly.
the program is more like a housing subsidy, and the goal of it is not to give people back their non-homestead property tax that they pay indirectly. It's to help especially low income families with the cost of renting.
So how many renters are there?
How many
Renters are there?
who receive the current
No, just,
75,000 households who rent in Vermont?
okay, thank you.
And how many get the renter rebate or renter credit?
I think it's about 12 or 13,000.
So not even 20.
Double check on that.
Now, it would be interesting to know how many apply for it and don't make it.
Yeah.
They think they're gonna get it. and then they don't.
Right. Yeah, we actually kind of know that because in the first year of the program, which was this year, the tax software companies weren't cutting anybody off. They were pushing everybody through. So we have all these people with higher incomes who applied for it, and we had to send them denial letters saying your income's too high. It was very awkward. Sorry. So I'll look at how many renters get it. Okay. Rural Vermonters. So in S212, there's no more homestead property tax rate. Doesn't exist anymore. And the homesteads that have more than 2 acres would pay the non-homestead property tax on any acreage outside of their house site. Currently, they pay the homestead rate on those acres. The non-homestead rate, as you guys all know, is a statewide rate that does not reflect locally voted education spending and is often higher than the homestead rate in rural communities. And that is because often in rural, not always, but often in rural communities, they spend less on education, so their homestead rate is lower. So what does that mean? Under current law, if you have like a 20 acre or whatever parcel, that's that big white box right there. The homestead tax rate is assessed on all of it. But then you can apply for an income-based credit on your house site taxes. That's that little white box that's shaded in. So like that's your house plus 2 acres. That's how it works right now. So if you do a homestead declaration, you're going to see the homestead rate on your bill. Under the education income tax as it's proposed in S212, there would be no more homestead rate to apply. So the way it would work is at the beginning of the year, you would do a declaration of residency, and the tax department would tell the local town listers to basically exempt your house site from taxes, don't tax it. And all the rest of your property value, tax it at the non-homestead rate.
And then approximately how many of those larger boxes are in current use? Percentage wise?
I'm not sure. To be in current use, you need 27 acres to enroll.
Yeah.
So I know a lot of zoning in some places is like 10 acre parcels. I don't know.
There's a lot of 10.1 acre parcels out there, a lot.
The reason that's concerning is because if you've been filing the homestead declaration for 25 years and then you see you're getting charged a non-homestead rate on your extra acreage, you're going to ask what is going on here. That's the first thing. The second thing is that the non-homestead rate is going to be absorbing in the ed fund all of the uncertainty because all your other sources are tied to the economy, your sales and use, purchase and use, meals and rooms, and now income. The only backstop you have left is the non-homestead rate, so it's going to get more bouncy.
Unless the non-homestead rate was divided up differently into more categories, that might be more stability in a different way.
Yeah. So, and that's something that I know we've been asked about is like, how do you because the legislature, ideally, it's like you just be taxing second homes, but non-homestead doesn't mean second home. That's not the same thing. It just means anything that's not somebody's primary residence. So we've been asked, well, how do you define second homes? And like, how would we tax them? And I don't know that. I'm not working on that at the moment, but.
Scott.
Right now, our homestead tax rate is local. You could just make it a statewide homestead tax rate. Just take out the house site and just say, we got a statewide homestead tax rate that applies to, that would take out all the volatility of the whole thing.
Interesting. So, okay. So then that would apply, that would apply to property of residents that's not in their house site.
That's right.
Okay.
Yep.
All right, we solved that one.
Yeah, no, there's a bunch of ways to solve each of these concerns, and it's really important to flag them all.
I mean, that would be simple, I think.
As would, yeah.
Okay.
The VHFA has been publicizing everywhere lately this metric that Vermont has actually the largest average lot sizes in the country.
Oh, really?
Yeah, which I thought was just an interesting piece of the puzzle. Yeah, bigger than anywhere else in the country. Yeah, significantly higher than anywhere else in the country.
It's all the 10.1 acre lots.
And that's mean, not median, so who knows what that means, but back to you, Jake.
The housing and demographics one, this one is very important, and I am glad that I'm at liberty to talk about this. It's important. So many states provide property tax credits to low-income households, but our $8,000 credit is by far the most generous. The next highest is Maryland at around $3,000.
I thought, I'm sorry to interrupt, but I thought we capped it at 54. I thought that was the change that you were describing a few slides ago.
The education credit, the maximum is 5,600. The overall credit, you can get up to 8,000. So 5,600.
You're a circuit breaker person.
2,400 meeting equals 8,000.
Thank you.
And we have heard how policymakers appreciate that this helps seniors age in place. That's a totally worthy thing. And the policy is definitely working. So since 1990, our average household size in owner-occupied housing has shrunk faster than any other states, according to the census. And as of 2020, we have the smallest average household size in the country. Respectfully, I ask that you have to think about, like, if all our large family houses that have 5 bedrooms are occupied by 1 or 2 people, where do the families live?
In other states.
That's a big problem.
And again, you're welcome to come to my neighborhood if you're in the mood for that. But it's difficult as a younger person. It was difficult for us to find adequate housing. We waited. That affected our decision with regards to how big we wanted our family to actually be. It's tricky. It makes property value go up because there's scarcity, there's less family homes available, and the school age population, will go down, which has been going down by about 1,000 a year for 25 years. So Vermont is very unique already. California has a famous Proposition 13, where you buy your house and it only appreciates at 2.5% a year.
Your tax bill.
Sorry?
Your tax bill appreciates.
Your property value, yeah. Maybe it is your tax bill.
Yeah, it's not your property value because
You can sell.
you can sell. The market in California is strong, but you get locked in with what your tax will pay.
Okay. So that partly, I think, is to help people age in place who have been in their homes for a long time. But if you retire in California, your tax bill is not going to go down by half because just your spouse is working. That's only in Vermont. So Vermont is going further than any other state to help people age in place already.
I would like the general universe that keeps on pushing for a full Social Security exemption to think about the full package of how we support seniors aging in Vermont financially when this conversation comes up again. Thank you. Back to you, Jake.
I totally agree. And I hope that someone will think about our entire tax code and how different groups fare like seniors. So yeah, seniors make the case like we exempt all our Social Security, but what about property taxes? What about sales taxes? So you really, if you're going to look at tax incidence, you need to look at all the tax types.
Yeah.
I don't really understand your second point or like why you included. I understand the statistic, but I'm not understanding what you're trying to tell us with it as far as this work.
Because the education income tax would go way further in this direction. So we're already going further than any other state.
But for size of the household, why would that change the household size?
Because if you are one person in a large house, suppose your house is worth $600,000.
So you're not being kind of pushed out because of the value of the house. So if you're one person in a big house and you're paying on income, you're like, well, it's fine. My property tax is low, even though I'm in a big, expensive house. But if we were to do it on property, you're like, I got to get out of here. I'm a single person. I got to go move to the senior home so the young family can move in.
Or just a less expensive condo. It doesn't have to be a senior home, right?
I mean, so if our property tax system were like other states, I think you would see more seniors leaving their houses. You know, and that's the reality of it in other states is that like, that's the decision that they make, partly because of property taxes.
Because they can't afford it.
Right, and like, you know, so that's why I'm saying, like, on the one hand, it's fair to want to help them age in place, but I'm asking to realize that it's connected to other things in the housing market. So the education income tax would push all of our chips into this basket for a bunch of reasons. Right now, you're only sensitized up to $400,000 and then you pay on property. So this is kind of like infinite income sensitization, because there only is an income tax. There's no tax. Social Security is non-taxable. Social Security is not an AGI, but it is in household income. And the circuit breaker rates in S212 are kind of have a funny phase in, but they're mostly lower than current law. So it goes even further in this direction.
Is there another state that collects its education taxes from the people 100% through income?
Not that I know of.
Yeah. Okay.
As far as I know, every state has a local property tax to pay for education. And I say every state has, I should say. It's not all, I think Vermont's is a statewide system, but within all of the 50 states, there's a local property tax to pay for local schools.
I know we're the
And-
statewide system.
Scott, we asked JFO and Ledge Council to look at this actually for the next meeting.
Okay, got it.
Senator Perchlik, did you have a?
I did.
Okay.
And is the Senate bill that you looked like basing it on AGI? Is that why you referenced that?
It feels to me like one policy goal that a lot of people agree on is to try to make what you pay for education more understandable, because right now it's difficult. So under current law, as we all know, in March, you vote on your school budget. And then in July or maybe August, the town gives you your tax bill. All the homesteads in your town are going to see the same rate on the bill. So that's kind of a good thing of the current system. The complexity is that the property tax credit is based on the prior year. So the 2/3 of households who get a credit, figuring out where that credit comes from is very hard. Why is it what it is? Why is it not sensitized to my current year income? What happens when my property value changes? So that's clearly the complexity in the current system. In the income tax, it becomes more complicated. So the first thing is that this idea that a taxpayer would indicate their residency status on their W-4. That's like your withholding form that you file with your employer. And then you have to select a withholding level, low, medium, or high. People don't go into their W-4s every year. You get hired, you fill out a W-4, and you let it ride. If you're super smart about taxes like me, you go in and you change it when you have a kid, when you get married, stuff like that, or if you're like figuring out some shenanigans. But for the most part, people just fill it out when they get hired, and that is it. And then the next job they get, they do another W-4. So there's no annual maintenance of W-4. And then you would vote in your school budget just like you do now. And then in the summer, nothing happens. There's no evidence of your vote that you just made. There's no property tax bill with a homestead rate. Your withholding is not changed. There's nothing to show that you just voted. And then the next year comes around. I don't know how you would know what to do with your withholding. Then you'd vote on your school budget again for the following year. And then in April 15th, you'd file your income taxes for the prior year, and that's when you would reconcile your prior year's education income tax. Reconcile a tax means like you kind of match up what you were supposed to pay versus what you withheld or estimated payments.
So you have your last block red or orange or whatever color you want to describe that as, the darker one. Orange. And then April 15, 2024 is orange. But it's referencing decisions made in March 2023, right?
That's correct.
So I would, if I was designing the chart, I would make that yellow. Just like,
It's for things that occur in 2024.
That's a new year, so it gets a new color.
yes, but it's like the math you're doing is math based on a decision you made in yellow, right? Okay.
Yeah.
I'm not trying to correct you. I'm just trying to get my head around what's happening. Yeah, Senator Pearson.
But a lot of these dynamics exist for people who are income sensitized already, right? I mean, the annual disconnect between your earnings and your property bill, I wonder if this doesn't seem to contemplate one of the benefits that I see, which is a voter sort of more directly understanding my yes vote means X, my no vote, means Y. Whereas now for people that are income sensitized, nobody, there's an estimate. If you go to an information meeting before town meeting or whatever, you get this is a 4.5% increase on our school budget. There's sort of an estimate on what it means on property values, but it's very disconnected from what most people think they were going to be paying.
So a yes vote would mean I'm going to pay 2% of my AGI for this year. And a no vote would mean a no vote would have to be voted again. Whatever percent of my AGI. I mean, how relevant is that? What is AGI to a taxpayer? The bigger question is, where would they find this number? They'd have to wait a year and then go in their packet from TurboTax and find the form and find the line to see how much they actually paid. And they've already voted for their new school year's budget. So it buries it. Like, this makes it disappear. Like, you could announce you have to pay 2.67% of your AGI versus whatever I said, but how meaningful is that compared to getting a bill in July that reflects your decision?
What I hear you saying, Senator Pearson, is that a core value for you, if implementing this, would be to make sure that we're actually drawing a tighter connection between spending decisions and the individual household's finances. And you're saying that the bill as drafted last session that you're basing your stuff on seems to you to be an even further divorcing from decisions and more complicated.
Yeah.
But we don't necessarily, again, we don't have to do it with a withholding system. There are lots of other ways we could do it.
Right. I mean, so.
Well, and AGI, it's not some big mystery. People just think it's their income.
Yeah.
Right. And so I think can do a quick calculation, but then they're a few $1,000s off, but I don't know.
Okay. So administrative complexity. So in S212, it's basically setting up a parallel tax system. It would have all the same features as our regular income tax system, but it would raise about a third of the revenue. It would have withholding, it would have estimated payments, and it would have an annual reconciliation. So you'd have both of these things kind of running in parallel. This second one is in bold because it's very important. The tax department cannot ask people who are getting a $500 refund on their regular income taxes to also send us a check for $500 on their education taxes. From a taxpayer perspective, that it's just too odd, So you can't reconcile them differently. They would necessarily have to be lumped together, which further adds to the complexity of it. Like, how am I going to find out how much I paid for education based on my vote last year? The third thing is, what happens if they're not required to file a federal return because their AGI is too low? So would they have to fill out some kind of new household income form to reconstruct AGI?
Can you, and I'm cautious of the thread this goes down, but at some point, just getting more information about how many Vermonters you think did not file in the last year. I think that's an important thing for us to know for just like general tax policy. Anyway, to be thinking about with the upcoming session with all the new tax credits and such. I saw Rebecca write it down, but.
We had a super talented intern who looked at that. And he did a really good job. He estimated it at 17% are non-filers.
17?
Yeah. So you definitely, here's how it works. If you're required to file federally and you have at least $100 of Vermont income, you have to file in Vermont. So that means if you're not required to file federally, you just don't have to. So of that 17%, a big chunk of them just don't have to file. There's no requirement. So if your question is about how many people are kind of like skipping out, like playing hooky.
No.
It's smaller. But the population who do not file is around 17%, we think.
Wow, okay, thanks.
We have been puzzling over like, how do you reconciliation basically, like what happens when somebody moves to a different town or to a different state? What happens when somebody leaves a household? Like at the beginning of the year, when you do this residency declaration, are you also declaring all the members of your household who are going to live there? Otherwise, like, how do we know what rate to be charging them? Like where, I don't know. There's some serious complexity there. What happens when a property gets sold? Like somebody declares that it's going to be their residency, and then they sell it, and it's now the house site is not being taxed because it's been declared as a residency. But what if the new person who bought it is using it as a second home? As of July 1st, what does the lister do? Like, do they, is there some sort of feedback mechanism so that they can bring it back on the tax rolls? What if somebody's planning to sell their house and move out of state, but it just doesn't sell? They think they don't file a residency in a residency declaration because they think, oh, I'm going to sell by May, but the market, is softening and they can't move it and they're stuck in their house. They didn't file a residency declaration. So there's all these kind of feedback loops that need a lot of support to work, and we have been puzzling over them.
I just quick question, back up to if a property is sold, a property is on a grand list anyway for municipal taxes. And if it moves from to a non-homestead tax or a non-homestead property, that's something that happens today anyway.
Moving between homestead and non-homestead, you mean?
Yeah.
Yeah.
Right. Yeah. So it's a little bit different because if the person has declared residency, then the house site is exempt from tax under the education income tax. You can't tax a house site.
Right.
So the question is like.
I understand. Yeah. Because that's different than a municipal tax where it's not a house site, homestead. It's not differentiated.
Yeah. Muni tax could flow as normal.
Yeah.
And the last slide is about volatility, which I think is, or maybe transition issues are part of our study. We know the residential, like the homestead, basically tax base for the coming year. We know it with almost 100% certainty right now. Income tax, we don't know. The relevant question here is not which one is more volatile in the past. the question is for setting tax rates, which one do you know for the coming year? No one, but the other one is pretty variable. So you might need to toggle the ed fund reserve or do something different with it to account for the volatility. As I mentioned before, the non-homestead tax would be the last one left to absorb any economic shock in the education fund, like there's a recession.
Yeah.
Can we just go back to number one? Because trying to understand how, right now 70% of our homestead tax is also income sensitized. Do we have, but is that because of the year lag that you're talking about? Is there somehow more certainty? I recognize it's not 100%, but it's a huge chunk of the homestead.
So property tax credits are also known with 100% certainty because in the spring, people file for their property tax credit and then we process them through the summer.
But we've already set the yield by then.
Yeah.
Anne, do you want to jump in?
No, I'm
Okay.
finding this very interesting.
Okay.
Okay, so I take it back. Property tax credits for the coming year, when you guys are setting the yields in May, are not known with 100% certainty. The way we do that is we take a prior year's filings and we grow their income and we update the property values and then we do an estimate of it. So the way we grow the income is from some consensus equations provided by the state economists, and it's not perfect. And in recent years, we've actually overestimated by a little bit. There
Overestimated the credit.
Yeah. So there is property tax credits. There is some variability, but I think when you're talking about the AGI of all the residents of the state, there's much more variability. Because especially with the higher income cohort, that's very variable and dependent on capital gains realization. The third one, taxing income more will result in less income, which will affect both the education income tax and the regular income tax. You tax anything more, you get less of it. Vape pens, carbon, you name it. That's a taxing fundamental. And whether it's from people moving, which is possible, or more likely like people just making different decisions, you will result in less income. It's called the elasticity of taxable income. There's lots of studies on it. Different researchers agree on the number, like how much income goes down, but they all agree that it does. High income folks are the most able to manipulate their AGI and residency status. And if their income is from a capital gain, like selling their Vermont coffee roasting business or whatever, they could avoid the education income tax by not declaring residency. You can't get out of the regular income tax, PIT, because that is designed to capture Vermont activity. It's not a binary thing that's on for residents and off for non-residents. Non-residents who realize the capital gain in Vermont have to pay on that. So you can't shake out of it. But you could avoid this tax if you're so inclined. And then for you guys to consider is like the impact of the tax to the cash flow, would be much different. It's on a calendar year, and then in March and April you have this reconciliation, PI paids and refunds, and then property taxes are on a fiscal year. So you'd have to look and see if you can get the money to the schools that they need. But it would only be about 25% of the ed fund. Some bigger tax policy questions. How does Vermont think of property wealth? The last couple of years in the Senate, there's been proposals to add like a surcharge when people buy $1 million properties.
Just want to give the House actually passed that multiple times and the Senate hasn't picked it up.
Oh, okay. Sometimes I don't notice it.
That's-
It's like in consumer.
We did talk about it.
I know you did. I know you did.
We just didn't agree.
I know. I was there even for that.
Okay, so in so what they were talking, what the House passed, and I guess what the Senate talked about was this thing called property transfer tax. That's like when you buy a property, the buyer has to pay this tax. That's definitely on property value. And the House said, if it's worth more than $1 million, those people can afford to pay it, charge them more. Let's raise revenue that way. That's a tax on property value. But now with this, when you're actually living in the house, once you're in it, it's not on your property value, it's based on your ability to pay. And then finally, if you die and you have an estate of 4 million or more, it's back to property value. And that's not based on ability to pay. A lot of the people who pay the estate tax actually have quite modest incomes. So should the estate tax, which is a wealth tax, be turned into ability to pay also? You know, what is $1 million house? Is it wealth?
Isn't a one-time household revenue increase still considered income? So the person with the $4 million estate that they've received, in fact, do have $4 million in income?
You might be thinking of inheritance tax.
Okay.
So estate tax is on the estate of the person dying. So basically like.
It hasn't been monetized yet.
Pardon?
It hasn't been monetized yet.
Right.
Okay.
Yeah, so you just add up all their assets.
But
in 16% of the amount over $4 million, something like that.
But it is based on ability to pay to some degree, because if it's under $4 million, there's no estate tax. So it's not the definition I would pick, but it is already trying to factor in this point, don't you think?
Yeah, I guess in a sort of very black and white kind of way, potentially. But if you are in a $500,000 home and you die and you do happen to be subject to the estate tax, what I'm trying to say is that home counts for $500,000.
Yeah.
Is this proposal consistent with the principles of the high quality tax system from the National Council of State Legislatures? JFO has a nice presentation on that, which I linked. Sustainability, reliability, the income tax is going to be more variable. Part of horizontal, so fairness is horizontal equity. Two people with the same income paying the same, and vertical equity is higher income people paying more. But part of horizontal equity, which JFO gets at, is not only just their income, but also their assets and whether they have a debt like a mortgage. That plays into it. So it's more than just the same income paying the same. We think that this would make it harder to understand. By setting up a parallel income tax system, which is without precedent in the country, it's not an efficient way to raise money. Some of the towns in Vermont are going to have the highest income taxes in the country after the pupil weighting. Like Norwich is going to have an income rate of like 4%. And so when you add that to Vermont's 8.75% top marginal rate, the people in Norwich would have the highest income taxes in the country. California goes like.
Nobody pays the top marginal rate, right? I mean, I don't mean to pick on you, but there's an effective tax rate. So I'm going to push back on taking talking points from the right wing here. Nobody pays the top marginal rate. They have an effective tax rate that is not the top rate. So I just think we need to be careful here, because I'm hearing a lot of what you're saying, and it also applies. It's unprecedented to have a statewide property tax. So that's what we have. So, I think we just need to, we're very dependent on your help to wrestle through this. And I get uncomfortable with those kinds of statements that also apply to the way we pay for schools today. And also apply to critiques that we hear all the time about our current income tax structure. So forgive me, but I react strongly to that.
No, it's fair. And along the lines of being helpful, I think that there's a lot of risk when you do something that's very different than any other state. So I urge caution. My point about the high income tax rates, Vermont's 8.75%, for married filing joint starts around 400 something of income. Other states actually have higher than that, like California is 13.3 or something like that. But it starts at 2 million, I believe, or something very far out. So I can crunch the numbers, but so people do look at top marginal rates as a comparison metric. So you in Norwich, you would have the 8.75 top marginal rate of regular income taxes plus your 4% education income tax equals 12.75. The weird thing about the education income tax is it applies to AGI. So on regular income taxes, it applies to Vermont taxable income, which is kind of downstream after all these various deductions mostly. So it's a difficult comparison to make, but we could put a table together that shows you the top tax in states. Tax neutrality is spreading taxes across a wide range of sources. So we would be very heavy on the income. There would be no resident education property tax. Right next door, you have New Hampshire, which has made a different set of decisions with heavy property tax and very little income tax. So, people say Vermont is New Hampshire upside down. This might prove that one. Accountability.
They're the ones that are upset.
They're weird.
They're upset.
Emily?
Yeah.
Yeah, just the original tax study committee recommended that we collapse those top two rates, trying to get that marginal rate down because we came out looking poorly, whether or not the effective rate was definitely lower than surrounding states. But the Ways and Means spent many years trying to get that top rate down. And we didn't manage to do it until I think it was 2015 with the Trump tax cuts that we did do it. But there was a reason that we tried to get that top marginal rate down. And even with that, I think we're the second most progressive, I guess, next to California. But we are down.
Yeah, so in 2018, we lowered it from 8.95 to 8.75 when we did the reworking of personal income taxes. And thank you for bringing that up, Senator Cummings. We also, I was heavily involved in that. We did a lot of what the Blue Ribbon Tax Structure Commission recommended, as much as we could, while keeping people's liabilities the same as much as we could. As far as our progressivity, what Senator Cummings is referencing is a report from the Institute for Taxation and Economic Policy, which is very good. It's called Who Pays? And it ranks Vermont as the second least regressive state. It does the second best job of not worsening economic inequality. But that report doesn't look at people over 65. And I bet if they had.
It doesn't?
It does not. If they had, I think we might be neck in California, or maybe number one. And, all black. So that's it.
Thank thank you very much, Jake. I hope you get a cup of tea.
Thank you.
Yes. So I think this is just like the beginning of a really deep dive, and I really appreciate what you all have been able to get through so far. I think it raised all the questions that we need to be discussing over this next 6 meetings.
Yeah, well, thank you again for inviting us in at your first meeting. And all the questions that you gave me for homework, I'm going to follow up on this week, and happy to help going forward with all the data questions.
I think we'll probably have more by the end of the meeting. So maybe we can confer after the meeting to figure out what those questions are. Thanks. With that, we are going to take a lunch break, and we will all be back in our seats at 12:58 to start up again.